Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Hello, and thanks for joining us for another episode of Friends with Money, Money Magazine's podcast to help you earn, save, and achieve your financial goals. My name is Tom Watson, a senior journalist here at Money Magazine, and as always, it is great to be with you. Have you ever wondered if it's possible to take out a loan to build your share portfolio? After all, it's a pretty common occurrence in the world of property investing, so why not with equities? Well, today we're going to address that question with a dive into all things margin loans. We'll be discussing how they work in practice, what kind of equities they can be used to purchase, and the potential benefits and risks involved. And to do all that, I'm very pleased to say that we are joined today by Lily Elliott, Head of Margin Lending Specialists, Leveraged. Lily, welcome to Friends with Money.
Hi, Tom. Thanks for having me.
You are very welcome. Lily, let's start off with the most basics of basics. What is a margin loan and how is it different from other types of loans that listeners may be familiar with?
A margin loan is a type of secured loan which allows you to borrow and allows investors to borrow money to purchase a range of securities. As an example, ASX shares, managed funds, and exchange-traded funds as well. The securities bought using a margin loan can be used as collateral for the loan. If you already own shares or have a portfolio, you can leverage them. This borrowed amount can then be used to increase your investment capital or to diversify the portfolio you already have. Otherwise, if you don't have a portfolio, you will need to provide cash, and that's used as an initial investment to start borrowing against the loan.
Right. So it's basically a line of credit then, is it, Lily?
That's right, Tom. A margin loan is like a flexible line of credit for an investor. It helps them or enables them to draw on the loan when they feel it's most suitable. Of course, that's as long as they stay within the specified lending limits, which is approved by us. We provide a credit limit and we use those approved as security as collateral. And also, a margin loan may also offer more flexibility than other loan products. Apart from interest repayments on a monthly basis, there are no scheduled repayments, minimum terms or maturity dates, and you might be even able to capitalise interest costs for some margin loan products that we offer. The other thing also worth mentioning is generally interest costs on the loan for investments are tax deductible. And this can make an effective strategy for some investors. And in particular, those who choose to prepay interest for the next financial year in advance, which brings forward the tax deduction to the current tax year. And that may be beneficial when you're tax planning.
Interesting. Lily, I just want to touch back on a point that you raised and really underline it. So what can investors use a margin loan to buy? Is it only Australian equities, or I guess are there other possibilities beyond that in terms of, perhaps other markets?
So usually you can use a margin loan to invest in domestic financial products such as ASX listed shares, exchange traded funds, and managed funds, depending on what the margin lender lends against. At Leverage, we also offer lending on international shares through a diverse range of overseas exchanges and stock markets. That way, the investors can access overseas exchanges like NASDAQ, as an example.
Okay. And just on ETFs as well, Lily, what are you kind of seeing there? Are they kind of as popular in the margin loan space as they seem to be more broadly?
One trend that we have noticed is that they've become more popular. Younger investors tend to like them because they offer an easy way to own a variety of assets all at once. They lower costs, but also some of the sophisticated investors also use them for diversification within their existing portfolios. Because of this, we are constantly looking for acceptable investment lists that we lend against and adding new ETFs that become suitable for us to lend against. And one of the things we look at is minimum market cap, as an example.
So they have to have a minimum market cap before they'll come up on a list that people can actually buy.
That's correct. And that's usually 100 mil.
Right. Okay. Lily, I think, to get our heads really clear and to clearly illustrate things, I think it'd be helpful to run through a bit of a scenario. So let's imagine that I'm interested in building my portfolio further by purchasing some CSL shares, for example. What determines how much I can actually borrow to purchase those shares?
Okay, so first and foremost, your capacity to purchase is made up by several different factors, such as your loan to value ratio, your credit limit, which is set based on our assessment on what you can afford, and available credit that you have on the particular loan if you already have it. But what I'll do is I'll start with the loan to value ratio, or what we call an LVR in short. It is a set level that will end up to a share such as CSL. And let's just say the LVR on your CSL shares that you want to purchase is 75%, and you have $50,000 in cash to invest. So we can potentially lend you up to 150,000. So you could buy a parcel of $200,000 worth of CSL shares in total. And of
Mm,
course, this is an example. You will consider different things such as your own risk profile and how much you actually want to gear. So I'll take it a little bit further. And this example that I've provided should consider, like I said, a level of gearing first and foremost, and that depending on your risk appetite. But if you have an existing investment portfolio and no loan, you could use those shares as collateral to borrow money from a margin lender.
right.
The total amount you can borrow is based on the combined value of the securities in your portfolio that the lender is willing to lend against. And let's say that your portfolio is worth about 100,000 and the portfolio has a maximum LVR of 60%, then you could potentially have $60,000 available to invest.
Mm,
Now, let's link that back to your original example where you said you wanted to purchase CSL, which had 75% LVR. You would be able to borrow against the 60,000 and buy a parcel of CSL that's worth about 240,000.
well,
Once again, this is hypothetical and for example purposes only. And the investor credit limit has not been considered in this particular example that we were talking about.
sure, definitely. We'll keep it hypothetical then. So let's kind of continue on the narrative then. I've happily purchased my CSL shares. They're sitting in my portfolio. When and I guess how do I actually start paying back that money that I borrowed?
Okay, so paying back that money that you borrowed is up to you. So if you want to repay all or a portion of the principal you borrowed, there's several ways that you can do that. You can settle the loan using your cash if you have some available. Alternatively, you can sell a portion of your investment to generate the funds needed for the repayment. And some investors also opt to utilize dividends received from their investment as a means to repay the borrowed amount or speed it up.
Ah, interesting. I didn't realize you could do that.
Mm.
One thing that I definitely got to touch on as well is how do interest rates work with margin loans?
So, an interest rate on a margin loan works in a similar way to interest on any type of loan. You can choose to pay interest through both variable or fixed method. For leveraged margin loan products, the variable interest rates accrues daily based on your daily loan balance, and it's charged to you at the end of the month. The fixed rate interest rates can either be prepaid in advance or fixed in arrears. And if you borrow more than you fixed, then a variable interest rate will then apply to the
Hmm.
exceeding amount that's left. And again, depending on which margin loan product you've applied for, you can then choose to either pay your interest monthly via direct debit or accrue the interest on your loan balance, which is known as capitalizing. That means that your interest payments are deducted from your available credit, which can compound over time. And one of the things that you need to be aware of that it can increase the total amount that you owe. So it's
Mm,
important that investors understand their options around that and also speak to their advisors if they have one or be really aware of what their investment strategy is.
sure. So back to my journey then, Lily. Let's say we're a couple of months or maybe a year or two down the track. Things were going really well, but all of a sudden CSL's share price has nosedived, and my shares are sadly now worth less than I paid for them originally. So is there anything that could happen with my margin loan if the price of those shares keeps falling?
Yes, investing is not without risk, which is why diversification is so important. And
Mm,
market or stock volatility can occur at any time, which is why we provide a buffer to allow for those market fluctuations. However, if CSL shares were to fall dramatically to the point where you exceed your maximum gearing level, plus the buffer amount that we offer, a margin call will occur. And then you'll be required to pay back the amount owing in a short period of time, which is 24 hours. But you can resolve the margin call by either adding more equity, perhaps shares that you might have elsewhere. Again, you can inject more cash into your loan or simply sell a part of the portfolio to satisfy the margin call. And one of the things that we keep talking about again is your gearing levels. So
mm,
those are the things that you can do to protect yourself as much as you possibly can is by not being geared to that level that we talked about. You know, if you've got a 75% LVR on your CSL shares and you borrow the whole 200,000, then obviously you are more likely to be impacted in times of volatility.
mm. I mean, that makes a lot of sense. It's starting to, I guess, come together in my head, Lily. But before we wrap things up, I think we'd probably all benefit from a bit of a recap on two really important points for investors, thinking about taking out a margin loan. The first of those, what are the potential risks involved?
So we talked about this just previously, and as we touched on, market risk is one of the things that always need to be considered. So gearing can magnify both losses and gains, and the
Mm,
market risk and volatility should always be considered. And that's why we'll diversified portfolio and sensible gearing levels need to reflect your risk appetite. Other risks include interest rate risks. We've seen in 2023 where interest rates went up quickly, and for those with variable loans would have been impacted by the increased interest repayments. And one of the things the investors should consider is returns, and are they lower or higher than the interest payments?
mm. Definitely something that people will have been thinking about recently. So if those are the risks, what are the potential benefits then?
So the key benefits of a margin loan are that it offers a flexible, tax-effective solution for investors who are looking to increase their exposure to the market or simply looking to diversify into different investments. You can also use a margin loan to diversify your existing investment portfolio without selling your current favourite holdings, as an example. Or you can build a new investment portfolio by combining your own capital with a gearing strategy that suits your financial situation, needs, or your risk appetite, as we
Mm,
discussed. But again, I can't stress how important diversification is. And many people new to margin lending as a strategy might only have a handful of what we call, the mum and dad stocks, the big
mm.
banks, or perhaps a couple of mining stocks. So some of the things that they might want to think about is how do they expand on that existing portfolio into other areas, industries, or as they see opportunities arise in the market.
Lily, this has been fantastic so far, but we're running out of time, so I think we're going to have to wrap things up today. Thank you so much for doing such a stellar job in giving us the lowdown on margin loans, and it's been a real pleasure having you on.
Thanks, Tom.
That's it for this episode of the Friends with Money podcast. But don't forget to jump on our website, moneymag.com.au, for your daily dose of financial news, or you can go grab yourself a copy of the latest edition of Money Magazine in all good newsagents. As always, we will be right back in your podcast feed next week. But until then, I'm Tom Watson. Bye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.